Hello, investors. Welcome back to EdFinance. Today we're exploring mutual funds and SIPs. We'll examine criteria for selecting the best ones. Crucial for long-term financial success, the right investments await. So, buckle up. Now you might be wondering, why are mutual funds and SIPs considered a dynamic duo in the investment world? Let's define them briefly. Mutual funds spread your funds across various assets, minimizing the risk of a failure. SIPs, however, encourage regular, disciplined investing rather than a one-time lump sum, regardless of the market situation. This regularity makes investing a habit and averages out the cost. So the benefits of diversification mutual funds and the discipline from SIPs create a sturdy foundation for your investment portfolio. Before we jump into the criteria, understand mutual funds and SIPs are preferred by investors. Mutual funds offer diversification benefits, and SIPs encourage disciplined investing. Combined, they're a powerful tool for wealth building. Now, onto the key criteria. Now that we understand why mutual funds and SIPs are so popular, let's briefly explore their types and workings. Mutual funds, being versatile, have three main kinds: equity, debt, and hybrid funds. Each type caters to varying risk levels and investment objectives. In contrast, SIPs, systematic investment plans, offer investors a systematic way to invest regularly in a chosen mutual fund scheme. These plans foster disciplined investing habits. Comprehending mutual funds and SIPs can aid in making informed investment decisions, which we will discuss in the next scene. The first and arguably the most important step is defining your investment goals. You need to decide, are you seeking growth, steady income, or a combination? Your goals dictate your investment route, choosing between equity, debt, or hybrid funds. They determine if systematic investment plans are right for you and whether SIPs fit into your investment plan. Now that we've defined our investment goals, it's necessary to match those with our portfolio. The secret to investing success is a diversified portfolio. Spread your investments in various mutual funds to mitigate risk. This might include equity funds for growth, debt funds for steady income, and hybrid funds for a balance. Systematic investment plans, or SIPs, are a wise way to regularly invest in mutual funds. This method provides a structured approach, potentially easing market volatility over time. Next, it's time to evaluate your risk tolerance and investment horizon. Understanding this is crucial, as risk levels vary across funds and your investment period can affect. This process allows you to find equilibrium and determine if SIPs fit in your financial plan. Now that we've understood the significance of risk tolerance and investment horizon, let's delve into the concept of diversification. Essentially, diversification is an investment strategy that involves mixing various types of investments within a portfolio. The idea is that a varied portfolio will generally yield higher returns and pose a lower risk than a single investment. Specifically, in mutual funds and SIPs, it can help spread your investments across various asset classes and sectors, thus reducing the potential impact of a poorly performing investment. Remember, diversification does not assure a profit or protect against loss in declining markets, but it can be your safety net in volatile times. A critical consideration is the fund's expense ratios and fees. This refers to the operational costs of a fund, calculated as a percentage of its assets. Lower ratios are desirable because they eat less into your returns. Remember, high ratios can significantly impact your earnings. Also beware of extra charges, such as front-end or back-end loads, potentially inflating your total investment cost. Investment decisions shouldn't be made in a vacuum. It's crucial to grasp the tax impact on your returns. Every mutual fund has unique tax consequences. For instance, equity and debt fund dividends are taxed differently. Long-term investments usually receive better tax treatments compared to short-term ones. Consult a tax advisor or conduct personal research to understand your investment taxation. While past performance isn't a crystal ball, it can provide valuable insights. It's crucial to examine a fund's past 5-year performance. Compare the fund's returns to relevant benchmarks. Consider consistently high returns as an indicator of potential future performance. Remember, consistency is key. Market conditions play a significant role in the performance of mutual funds and SIPs. Understanding this role is crucial as the fund's performance varies in different market conditions, whether it's a bull market, bear market, or periods of volatility. Its resilience and ability to deliver returns under these different conditions provides a comprehensive idea about its stability. Remember, economic factors also impact performance. Hence, a fund that performs well in diverse situations could be a safer bet for the long term. The fund manager is the driving force behind a fund's success. Assess their history, strategies, and practical skills. A seasoned manager with a proven track record can significantly enhance a fund's performance. Investing is not just about the fund manager and the portfolio holdings. The size of the fund is vital. Larger may offer more stability, while smaller ones may be agile. The former may lack agility, the latter may pose higher risks. The size impacts performance and risk level. So take the time to consider the fund size and how it aligns with your investment strategy and risk tolerance. Take a deep dive into the fund's portfolio holdings. Examine the allocation across various sectors and asset classes. It's important for risk distribution and reliable returns. Familiarize yourself with the types of securities the fund invests in and their associated risks. In the investment world, everything is interconnected. SIPs are linked to mutual funds whose performance impacts the SIP. Reviewing the fund's portfolio shows you where your SIP investment goes. A diversified mutual fund might offer better returns, making your SIP more effective. In the world of investments, staying static isn't the best strategy. After initializing your SIPs and mutual fund investments, periodic monitoring is necessary. This doesn't imply daily scrutiny, but rather a routine evaluation. During this, you gauge if your investments are yielding anticipated results and aligning with your objectives. If not, rebalancing your portfolio becomes imperative. This may require redirecting your SIPs into varying mutual funds or altering investment sum. The market is dynamic, and accordingly your investment strategy should be too. Regular monitoring and rebalancing ensure your portfolio stays robust. It's all about staying in the driver's seat and steering your investments in the right direction. And there you have it, your guide to choosing top mutual funds and SIPs. It's crucial to know that investing is a journey. Make wise decisions and it will lead you to success. If you like this video, please thumbs up and share it. And remember, don't skip hitting the subscribe button. Happy investing and see you in our next video.